Hey, good afternoon, everyone. Good afternoon. Hi.
Good afternoon, Professor.
How are you,
Hi,
Mohammed? How are you, Hannah?
I'm good,
I'm
thanks.
good. How are you?
Good, good. I'm good. I'm glad to see five of you here. We're still awaiting the rest of the class to join, but at least let me check on the in the discussion board. There are six people. Six people in the discussion board, and I have five here, so uh, just one person has not joined the collaborate session yet. Um, I believe everyone is aware that uh, the due date for homework one has been extended to this Wednesday, the 28th. Right? Everyone is aware of that, right?
Yes.
Yes,
Oh, thank you. Thank you for responding. At least Hannah and Mohammed is actively participating uh, in this session. How about you guys? Christopher, Samir, Jimena, are you all aware the deadline is extended for homework? Homework one is extended to this Wednesday. So it seems like Christopher and Samir and Jimena are practically okay. Okay, you just can't talk. Okay, Samir. Now, yeah, let me share my screen because there are a couple of things that I want to. Okay, share screen. So you're looking at it. Um, so in the announcements, okay, that's not what you can see. That's something you can see. Okay, do you see this? How to name your homework file and when sending an email to me, right? These two postings, these two postings I've just, I think it was today or yesterday, they were, okay, one thing, how to name your homework file was posted yesterday. That's July 25th. And sending an email to me, that was posted today. So everyone can see that, right? So it has to be, your homework file should be named this, and it's an Excel file. Someone already sent me the homework, but in a Word file. And first of all, uh, there's no there's no point in doing. I mean, how would you do it in Word? And you must do it exactly as taught. Um, and the Excel, if you Excel file can be, you know, it can be examined. In other words, how you did, uh, how you got the solution, right? How you got the solution can be um, examined because I can look into the cell and what formula you have put in there, and I can check if the formula is pointing to the correct input data and things like that. I mean, some people just um, send me a file with no with no formula with no formula view. In other words, uh, they got the answers, but it's just manually typed in. In other words, the answers were not solved for, but they were manually typed in. So in other words, there is no formula, and something like that is meaningless, right? There's no point. Uh, Because that's simply there's no proof. There's no proof if you send a file like that with no work but just the numbers manually entered in the solution cell. There's no proof that you did it yourself. There's no proof you know how to do it, right? So you must work it out with the formula, and in the solution cell it should be the formula, right? Not the number. Of course, if your formula is correct, your solution cell would have the correct value in it. But otherwise, there's no proof that you did it yourself, or there's no proof you know how to do it, right? So that's what I want to see in your homework, right? All right. The second thing is that when you send me an email, and I want you to, I gave you my personal email. You send the email to my Yahoo account, and in the if you want my reply, I will reply to that email. And if you have further questions to that, you just reply to my reply, so that all emails will be in one string, right? All emails will be under one thread. You understand? That way, I can always review the history. I can always review the history and what conversation was, what conversation was carried out, at what date, what time. All this will be all in a single string, right? In one thread, in a single thread. And I can review and research the history, and I can uh, trace, where the conversation had a hiccup or so. Unless it is about a different topic, for example, in the subject line, if you send me an email with a question about homework 1, just keep replying to that email, okay? Unless it is about homework 2. I mean, if it is about homework 2, then it will be a separate email. But if it is about homework 1, just keep replying to the same email. Don't compose a new email, so that everything will be in order. Everything will be stacked up in nice chronological order, so I can review and research the history. Okay. All right. I guess this one you may have received. Let me check, because I believe I received that. All right, let me check. All right. Yeah. You got this email because I got this too. So this one, if you didn't get it, I'm gonna send it right now. Send a copy of this. There you go. All right. So you must have received that. Okay. All right. I just, I just confirmed. I received that email to my BMCC account, so that has been confirmed. So let me go to not this one. What is this? Document class. Okay. Let's do. Oh, did also. Okay, I think this one is the file I've been working on. Where is the file? Okay. So we were talking about the promissory note last time. Does anyone remember? Okay. So promissory note is most preferred means of payment by the buyer or by the seller. Does anyone remember this conversation we had? Anyone remember this conversation?
The buyer?
Yeah, by the buyer. Yes. And who was this? Hannah?
Sarah?
Oh, Sarah. Okay, there you are. Because, there was only Hannah when, earlier. Okay, Sarah. Thank you. So 0.25 for that. Let me just check. There are 8 people, right? Except myself. So there's Christopher. Christopher, please raise your hand if you are here. Raise your hand. Okay, thank you. Hannah, raise your hand if you're here. Thank you. Maricel, please raise your hand. Thank you, Maricel. Mohammed, please raise your hand. Thank you, Mohammed. Monique, please raise your hand. Thank you. Sarah is here. Yeah, Monique, I got you. Monique, you don't have to. Hit it. Monique, I got you. I got you. You don't have to keep doing this. Okay, I got you already. I lowered your hand, so you don't have to keep doing this. Sarah is confirmed. Samir, okay. Jennifer, thank you, Jennifer. So that makes it 9. Okay. And Samir, can you raise your hand, Samir? Samir, thank you. You can lower your hand. Jimena, can you raise your? Thank you. So confirmed, 9 people. Thank you. So as Sarah confirmed, as Sarah answered, promissory note. Someone said something. As Sarah said, promissory note is the most preferred method of payment for the buyer because promissory note takes it buys you time up to 60 days. Theoretically, it can be up to 270 days, but think about it. No seller wants to receive a promissory note that has maturity for longer than 60 days because they will be missing out on that. First of all, most sellers are small businesses compared to the buyers. For example, it's not always true. For example, let's think about the computer manufacturing. The most computer manufacturers like Dell, Apple, or Hewlett Packard, Toshiba, Samsung, LG, Sony. These computer manufacturers, they buy parts from part manufacturers or part suppliers. But now let's think about it. Among the parts and components, the most important component would be the microchips, memories, right? Those microchip makers, memory chip makers, they are also very big businesses. They are industry giants. Samsung makes their memory. Hynix, Hyundai makes their memory. I mean, there are, Intel makes the memory chips. AMD makes memory chips, but these are also industry giants. But compared to that, some relatively less high-tech parts like mouse, keyboard, and things like that, some peripherals, not the main components, but the peripherals, computer peripherals. These manufacturers are relatively small, and they are supplying these parts to computer manufacturers like Dell, Hewlett Packard, Samsung, and Sony. And so think about it. Between the two, usually these suppliers are smaller companies, small businesses. But I'm not saying they are all really small. They are on certain scale. I mean, manufacturing is on certain scale, especially if it is electronics. But a small supplier, think about a small supplier. If they receive, suppose a mouse manufacturer sold, 100,000 units to Dell computer, and each mouse is $10, let's say. So there will be $1 million, isn't that right? $1 million. And if they don't collect this payment as soon as possible, there is no small supplier that can sustain their business for more than like 60 days without collecting this payment of $1 million. Basically all small businesses are always constantly short of cash. Okay, all small businesses are constantly plagued by cash flow shortage. So it goes without saying that these sellers are not happy to receive promissory notes. Make sense? So from the seller's perspective, it's exactly the reverse order. It's opposite. Sellers prefer the cash, right? Cash is the preferred payment method preferred by the seller. And check is the next. Credit card. Maybe credit card. They get it. Probably check and credit card. The delay is pretty much the same. About at most 3 days. And the promissory note can take up to 60 days. So there's no seller that is happy or willing to take the promissory note. But then think about it. are they in a position? I mean, are they in equal? Do they have equal bargaining power between the buyer and the seller, the computer manufacturer and uh, the parts and components supplier? Between the two, do they have equal bargaining power? Tell me. Can anybody? I mean, it's not that difficult to understand this, dynamics, power dynamics here, right? It's not. They are not on equal. They are not on equal footing. That makes sense. Someone, can you please? I can't.
Can you repeat the question, Professor?
Okay. So pay attention. My question was, between the buyer and seller, do they have equal bargaining power?
No.
Yeah, definitely not, because, as I said, in computer manufacturing, I mean, I just used computer manufacturing as an example. Buyer has more muscles because buyers are giant industry giants, and sellers are generally smaller manufacturers, right? Small businesses like uh, computer manufacturers like Dell buys parts like keyboard, mouse, so-called peripherals. They buy these peripherals from the parts manufacturer, right? And parts manufacturers are smaller companies, and for them, I just used an example of mouse, right? If they sold 100,000 units, 100,000 mice to Dell, and that's at $10 each, right? That's like $1 million, and $1 million revenue for a small manufacturer would mean their entire probably at least 50% of their quarterly income. So they are not in a although they are not happy to receive promissory note, they are not in a position to say no. If they say no, they can always take that business somewhere else. There are other suppliers of mouse, right? Do you understand?
Yeah.
Is everyone clear about that? Yes,
Yes.
because
Yes.
yes, these parts and components are relatively requiring less technological capability to make them, right? I mean, they are computer manufacturers. Computer manufacturer has they are at a higher end of technology, and they are basically without the computer manufacturers, right? These parts manufacturers of the parts, they have no buyer. I mean, they cannot run their business. So if you put, think about it, there this power dynamics, right? Who can flex more muscle in the market? That's obvious, right? Computer manufacturers can flex more muscle, and the parts manufacturers of parts or the suppliers of parts, always suppliers are also called vendors. Vendors are at a smaller end, or what do you call it? Lesser end of the equation, or the lesser end of the stick. They are holding the lesser end of the stick, and the buyers who are industry giants are holding the bigger end of the stick, right? Makes sense. So they can always give pay with 60-day promissory note, but the seller cannot say anything. They will, because they have to please the buyer. Otherwise, there won't be any more sale in the next quarter, right, or next year. So this is the reason why, promissory note is now, but most preferred means of payment by the buyer. And also, I explained last time that so if I can, so from Dell's perspective, right, from Dell's perspective, if I can defer payment for 60 days, that means I can use this $1 million, and I can use it for what? What purpose? For more lucrative purpose. For example, I can put this $1 million for 2 months in some stock that can return 10% on my investment. Then I would definitely do that, right? Of course, there's no guarantee, but there's a good chance on average, I will get 10% return on this $1 million. Then I would do that, and then 60 days later, I sell the stocks and cash in, right? And then I can pay $1 million 60 days later to this seller, and then I have this, I keep this $100,000, 10% return for me. And then for the same reason, sellers are foregoing that opportunity to make that 10% return. Isn't that right? Think about it. If seller received $1 million in cash, right, at the time of the transaction, right, the seller could have done this. The seller could have invested that $1 million in that stock that returned 10%, right? So basically, seller is foregoing that opportunity to make that 10% return, right? Obviously, seller has a good reason not to like promissory note. But then, so usually, but as I said, seller is at a short end of the bargaining stick, right? Seller is holding the short end of the bargaining stick, so they cannot say anything. But what if both the buyer and the seller are kind of equally powerful, and not all the part makers are small. As I said, Intel is a chip maker, and Intel is a huge company. Intel is more influential actually than Dell. Dell is a huge manufacturer, computer manufacturer too, but in terms of its revenue and in terms of its size, asset size, I think Intel is bigger. But between the two, then this power dynamics is not skewed. It's pretty much equal. And so obviously, think about it, the balance of power is pretty much equal. So Dell can order 1 million microchips from Intel, and let's say the price of the microchip is $20. Then that's $20 million, isn't that right? $20 million. And Dell would normally pay with promissory note. Intel may not obviously Intel would not prefer to receive promissory note because it's obvious why. Intel will be foregoing the opportunity of investing this $20 million into something that can, in other words, if they receive promissory note, if Intel receives promissory note, they will be foregoing the opportunity to use that money, to use that, $20 million in their own, for 2 months. Right? So, but what can, but Dell cannot just impose this on Intel because Intel is also a very big company and powerful company in the market. And if Intel decides not to continue business with Dell, they will have hard time sourcing their microchips. Of course, there are other microchip manufacturers, but if Intel's chips are the best, and Intel's chips are the most competitively priced, right? If Intel's chips are most competitively priced, then they cannot just impose this promissory note on them. So what would Dell do to facilitate? What would Dell do to induce Intel to receive their promissory notes? Does anybody have any thoughts about it? No one? Did you not watch the video?
I'm sorry, I lost the connection, so I didn't hear what the question was.
Oh, okay. The question, it's really difficult to repeat this. Now, since
I got
Intel,
the majority of the question, just the very end of the question I didn't hear.
okay, the end of the question is to induce Intel to accept a promissory note to facilitate acceptance of promissory note by Intel. What would Dell do? Is there something that Dell can do to make it smoother for Intel to accept their promissory note?
I would think having some sort of an incentive, like a little extra off the top or something of that nature, would make sense in my opinion.
Yes, that's the logic. That's the logic. And who was this? Who is
Jennifer.
this?
Jennifer.
Okay, Jennifer. Okay, Jennifer. Okay, Jennifer. So you get 0.25 points for that answer. So this is, yeah, an incentive. An incentive. You have to incentivize it. So what is that incentive? Well, that's why promissory note pays interest. Okay, promissory notes generally, think about it. Promissory notes, to make it easier for the supplier to accept a promissory note, the buyer pays interest on the at least market interest rate, on the promissory note. Because think about it, the worst you can do with the lowest return you can get with this $20 million. Let's say suppose Dell paid cash, right? For these 1 million microchips, Dell paid cash. And so Intel received $20 million. But even if Intel received $20 million, if they cannot find the right investment instrument, right? If they cannot find the right investment instrument, or there's an investment instrument that's paying you 20%, but the risk is very high. On average, you may get 20%, but there's still a big, huge probability that you can lose. The return is, negative 100%. I mean, you're losing it all, right? If you lose it all, that's return is negative 100%, right? So there's still a big probability of losing everything. So or there aren't very good investment instruments. So then what can they do? They will put it in the bank, right? If they receive $20 million and they don't find any good investment opportunity, then they will put it in the bank, right? So think about it. That's why promissory note pays at least something like market interest rate, because by paying promissory note, the buyer is taking away the opportunity from the seller to use that money to earn at least market interest, right? That they could have earned from the bank. Okay? Does that make sense?
Yes, it does.
Okay.
Yes.
There's almost like a 5 seconds delay. For a minute, I thought I was just speaking to the vacuum. All right, so yeah, that's promissory note. I've been telling you, promissory note looks like a check, but the difference is that promissory note carries interest and promissory note has maturity. Okay, and the thing is here, so if Intel received $20 million promissory note, but the maturity is 60 days. The thing is, a company like Intel can hold it for 60 days, right? A company like Intel can hold it for 60 days, no problem, because it's a big company. They don't have such a huge, cash flow shortage. And if they hold on to it for 60 days, then they will redeem $20 million plus interest. If the interest is 10%, then $22 million. Okay, they will do that. But as I said, most of the suppliers are not like Intel. They are not huge companies. They are small businesses, and small businesses are constantly suffering from cash flow shortage. They are very, tight with cash flow. So what do? Then do they have to, if they keep holding on to this promissory note for 60 days, they may, on day 30 or on day 20, on day 40, some cash flow shortage problem happens. They have to make payment, but they don't have any cash. What do? I mean, they can go bankrupt, right? They can go bankrupt for not being able to meet the short-term payment obligations. But it's not that they don't have any cash flow. They just don't have cash. They have liquidity. Liquidity here, they have already like $20 million in promissory note. And with interest, that's $22 million. Right? If they just can hold on to it until day 60, they are good. They are okay. They are, but then the payment is due on day 30. They cannot wait until day 60. Payment is due on day 30. They have to make this payment, but they don't have any cash to make that payment. They have liquidity. This promissory note is liquidity. It's cash flow. Cash flow doesn't mean necessarily cash, right? Cash flow is any liquid asset. So some companies go bankrupt even with, even if they have decent cash flow, even if they have, they are making profit, even if they are making profit, but this profit is not in cash. This profit is, just accounts receivable. This profit is from the accounts receivable. In other words, it's something they can receive but not have received yet. But then, because they don't have cash, they can go bankrupt even, with profitable business. So then, is there any way they can avoid bankruptcy? Oh yes, there is. There is a way to avoid this bankruptcy. What is that? They can do something called factoring. And what is factoring? Factoring is, in other words, in another term, factoring is called a simple discount. So what is simple discount? Simple discount is, basically, so today is day 30, right? You have this, you still have 30 days remaining, right? To receive this payment of $22 million from Dell. But this is day 30, so it's not maturity yet. But you have to make the payment that is due today. Then what you can do is you take this promissory note to the bank or a financial company, a finance company. So some finance company, right? That is usually specializing in buying these short-term assets. So if you do that, think about it. They're not. You're basically selling this promissory note worth $22 million, right? But then they're not gonna pay you full price. They're not gonna pay you full price. Why? Because think about it. They will have to discount it. Why? Because when you sell this promissory note to a third party, let's say a bank, what does that mean? The bank is taking over the risk from that point on. For the remaining 30 days, the bank is taking over the risk. Risk of what? What is the risk? Let's think about it. What is the meaning of risk? And in this context, right, the context is basically lending and borrowing context. Lending and borrowing context. Isn't that right? Why? When Dell paid with promissory note, right, 60-day promissory note, it's like borrowing for 60 days. Isn't it right? Because Intel is entitled to receive $20 million in cash right now at the point of transaction. At the time of the transaction, they are entitled to receive the payment of $20 million. But then they are permitting the buyer to postpone the payment, to defer the payment for 60 days. So it's effectively like giving a 60-day loan to the buyer. Isn't that right? Is everyone clear about that?
Yes.
Okay, good. So in a lending and borrowing situation, so in that context, the seller gave 60-day loan for $20 million, to the buyer, and we are assuming with 10% interest. So From the lender's perspective, right? From the lender's perspective, what is the most relevant risk? What is the biggest risk? What is the most prominent risk? What is the most
They won't get their money.
Yeah, not getting their money back. And in one word, actually, what is that called? In one word, I mean, it's two words actually. It's something risk, right? It's risk of not getting the money back. So what is that called? If the borrower fails to pay, right? If the borrower fails to pay, what is that called? I hear a lot of background noise, but actually nobody's saying anything. If you don't get your money back, which means the borrower fails to pay, what is that situation called?
Defaulting on their payment.
Yeah, defaulting on their payment, yes. So that one word I'm looking for is default, right? And who said that?
Jennifer.
Jennifer, okay, Jennifer, you got another 0.25 point for answering that. So the most relevant risk, most outstanding risk, most obvious risk in this context, in lending and borrowing context, is the default risk. Okay, default risk. So basically, think about it. If so you are the buyer, you are the seller, so you're holding this promissory note, and on day 30, you took this promissory note to the bank to sell it. And then at that point, the bank isn't going to give you full face value, full maturity value of the promissory note. They will have to discount it because they are taking over the risk from this point, because they are from day 31. On day 30, if on day 30 they if they sold this promissory note to the bank on day 30, then from day 31 until day 60, the bank is basically taking this risk, right? The bank is taking this default risk. So they have to be compensated for taking over the risk. So they will discount. Okay? So they don't give $22 million. They don't give out $22 million. They will discount it. And the question is, basically, what kind of discount rate will they use? I mean, if they, for example, if they pay them only $20 million, what does that mean? The bank is taking basically, the entire $2 million that was, part of that maturity value. But think about it. Do you think it is fair if the bank? So it works like this. So bank pays out $20 million to Intel. Intel takes $20 million and just walks away, and the bank is holding this promissory note with the maturity value of $22 million. And at maturity, they present it to the issuer, Dell, and they collect $22 million from Dell. Okay? And from Dell's perspective, it doesn't matter who presents the promissory note. Dell will honor their promissory note to whoever presents it. Make sense? That means the ownership of that promissory note was transferred from the original recipient to this bank. Okay? So it doesn't have to be, there's no name, right? It doesn't have to be, the promissory note doesn't have name of the recipient, And even if it does, it doesn't matter. Even if the original recipient was Intel, it doesn't have to be Intel to present it to Dell to collect the money. It can be any third party, because there has been Dell understands that their promissory note could have changed hands many times, right? Makes sense? So this is the way the promissory note works. The supplier or the seller receives promissory note, and if they can hold on to it until maturity, fine, they will hold on to it. But most of the companies, most of the sellers that receive promissory note, they will try to cash it ASAP, right? Without waiting for 60 days. Most of them will just, hold it if they can, but they will try to cash it ASAP. So once again, the process to discount the maturity value of the promissory note is called simple discount, right? Simple discount. And it's also called factoring. Actually, in the industry, it's called factoring. Okay, it's called factoring. Now, so let's take a look at this example. There's a couple of things that we need to summarize. First of all, the symbols. B stands for bank discount. Okay, bank discount. Bank discount is basically maturity value, that FV, that's future value, as well as the same thing as maturity value. Why? Remember in our example, the maturity value was $22 million, right? Because there was interest, 10% interest. Of course, when we say 10% interest, that means annual. The 10% is annual, right? Always the interest rates are quoted as annual. So actually for 60 days, you know how to make adjustment. For 60 days, it would have to be, 10% times 60 over 360, right? Isn't that right? If the maturity on the promissory note was 60 days, the interest, actual interest on this promissory note is 20 million times 1 plus 10%, right? Times 60 over 60. So in our example, the maturity value in our example is 20 million times 1 plus 0.1, because 0.1, that's 10%, times 60 over 360. Okay, that will be the maturity value. But again, just for the simplicity, just to make our thought experiment simple, we would assume just 10%. Okay, then what is B? B is the bank discount. So the bank discount is basically the interest they take out up front. So for example, in our example, I said, so on day 30, they took it to the bank, they took the promissory note to the bank to sell it. And so they were able to sell it, and the interest the bank took upfront was $2 million, right? So they got only 20 million. This $2 million is called bank discount. It's the interest taken upfront. Okay, and you might wonder, oh, so that's 10%. That's 10%. So the discount rate is 10%. Now, actually, if you think about it, if they took 2 million out of 22 million, they took 2 million out of 22 million. So it's not 10%. It's actually slightly less than. So what is that? What would that be? 2 over 22, right? So that would be less than 10%, right? But anyway, the idea is, how do you calculate? So in our example, discount rate is like, you can simply 2 over 22 is what? You can do 2 over 22. Can anybody do this calculation? I already got it. So you missed the chance. You missed out on the chance to get 0.25 points. So it's like 9.09%. So 9.1%. It's just almost like 9.1%. So in our example, if they took, and also you try it out. In our example, right? Bank discount is 22 million times 9.09% for 1 year. I mean, let's say this is 1 year, right? For 1 year. But to make really an adjustment, you would have to make, do this 60 over 360, which is 1 over 6. But again, the bank discount, for 60 days already, I mean for 30 days, for taking over the risk for 30 days, the bank took already 2 million. So that's 9.9% is for 60 days, and this was just to make our thought experiment simple. Okay. So that is our and here once again it's the same thing. FV. Where is it? FV is the same thing as maturity value, right? They mean the same thing. And then the difference between, so if they took $2 million up front for interest and you got $20 million, what's the $20 million? That $20 million is called bank discount. I'm sorry, proceeds, right? That proceeds. I didn't put any D here, so I don't know why. But uppercase D is called proceeds. proceeds. And if you think about it, we can rewrite proceeds this way because by definition, what is B? Can anybody give me the definition of B? Mathematical definition, not verbal definition. Anybody? Come on. I have 9 people. Let's see. One is inactive. I don't know who is inactive, but Christopher. Christopher, can you hear me? Raise your hand. Christopher. Okay, I believe, Maricel is inactive. Okay, I guess she got disconnected. But Christopher, can you hear me? Hannah. Christopher is inactive. Hannah, yes. Okay, you can lower your hand. Hannah, can you give me the definition of B, the bank discount? Can you give me the mathematical definition of B?
I'm not really sure what you mean with like the B for
B in this bank discount. What is the definition of B?
what the. Yeah, I'm not really sure.
Well, okay, someone else? Someone else? How about John? John, are you there? Okay, John is inactive. Monique, are you there, Monique? Monique? Also inactive. Samir, are you there, Samir? Okay, John and Samir are inactive. Jimena, are you there, Jimena?
Yes, I'm here.
Okay, Jimena, can you give me the definition of B? I don't know if anybody is, where is Jennifer? I mean, Jennifer was very active before. Now I don't see her even, in the, okay, let's see. I can't, I hear some dings, but, I have to, oh, Jennifer, there
I'm
you
here.
are. Okay, there you are. So, Jimena, can you give me the definition of B? No? How about you? Okay, Jimena, go. Yeah, go ahead, Jimena.
It's the interest upfront.
Yeah, you're right. You're right. It's the interest up front that the bank takes. But then that's just verbal definition. Mathematically, how is it defined? Mathematically, how is it defined? Or algebraically, how is it defined? All right, Jimena, this is the definition of B. You see, you're looking at it right in front of you. B equals FV times D times T. What is FV? That's the maturity value. What is D? D is the discount rate. Discount rate. T, time. Remember, when in our example, the bank took $2 million as interest up front. They took interest up front. That was $2 million, right? And that was our, assumption. That was, Of course, this is also million, 22 million. And the discount rate used, I mean, because I just calculated it like, 2 million divided by 22 million, right? So that's 9.09%. And for 1 year, I mean, it's a little bit off. It's a little bit off from our assumption, but because our scenario was this promissory note was for 60 days only. So actually, to take 2 million as interest for 60 days, of course, it would be much bigger rate than this, right? We can exactly nail it later, but just to make the thought experiment, just to make it simple, we assumed we just simplified it as 1 year. But then think about it. That's how bank discount was calculated. And if this is the definition of B, we can rewrite B by its own definition. Isn't that right? Everyone follows. Everyone is following, because B is defined this way. Yeah, you can rewrite or you can substitute this B by its own definition with its own. So then, and what is D? Once again, D is proceeds. In other words, D is what you take. D is what you take. You get, get the proceeds. So anyway, Jimena, I will give you 0.25 for answering that question. So if you, and D, so basically D is proceeds, which is the portion of that promissory note that I keep, right? Bank took 2 million, and I keeping, I got 20 million from the bank, and eventually on day 60, bank will present it to the issuer of the promissory note, which is Dell, and they will collect 22. So that completes the cycle, right? That makes sense. That completes the cycle. The bank will get their 20 million back, and they have already took, and they are receiving 22 million. So they got their 20 million back, and 2 million they get for taking over this from discounting this promissory note. So, and if you look at this formula, I mean, this expression, you understand, I've been telling you from the day one, in math, math doesn't like redundancy, right? Everything has to be compact and concise, right? It must be there. So I gave you the example of redundancy, in the last topic, like when we say John goes to BMCC, Sally, I go to BMCC, Sally goes to BMCC too. John's sisters, okay, I go to BMCC. John goes to BMCC. John's sister Sally goes to BMCC. This is, and if you say that, like, I go to BMCC and John goes to BMCC and Sally goes to BMCC, then this is redundant, right? And that's not a good form. And not only math, even a good writing despises redundancy. So the good writing, good style is always John, comma, that's Oxford, comma, right? John, comma, Sally, and I go to BMCC, right? It's also like, factoring out we are factoring out common factor. Go to BMCC is the common factor. So just like that, we have to factor out the common factor. And the common factor here is future value, right? So if you factor out the common factor, this term becomes 1. This term becomes only dt because FB is factored out. It's actually 1 dt. You don't have to write 1. So finally, that's why d can be written this way. D is equal to the future value or maturity value times 1 minus dt. Okay? So everyone is clear about that?
Yes.
Yes.
Okay, thank you. Thank you. Only 2 out of 9 people, only 2. What about the rest of the class? Are you fine? Do you follow? You clear about this?
Yes, we follow.
Okay, great. So now let's go to the example. I would like to let me. Okay, let me clear out. It doesn't have to be like this. Plus 180. Okay. And do you have this file in front of you? Do you have this file in front of you?
Yes.
Okay, good. I want you to clear out all the highlighted cells. Again, another thing, in your homework 1 is due this Wednesday. You must, the solution cells must be highlighted by yellow. Okay, just like I do here. Solution cells must be the primary solution cell, right? The primary solution cell must be highlighted by yellow, and the intermediate calculations, right? The cells with intermediate calculations, some light olive, light green, or something light, very light. Okay, it's usually that olive green or drab, right? So here, what is this? In this example, principal is, this is a promissory note, $200 promissory note, and the maturity of the promissory note is 2 years. Actually, this is not realistic example. Why? Because I've been telling you, promissory notes normally don't have maturity longer than 60 days. And even if theoretically it is possible to have maturity up to 270 days, that is rare. Very, it doesn't, nobody takes, like, so basically, the timeline cannot be more than 1 year. So if the promissory note has maturity of 2 years, then obviously that is unrealistic. But it's just a practice, so it's an exercise. So we can assume that. So how do we find the proceeds, and how do we find bank discount? We can do it, one of the 2 ways. First, I can do it this way. First, we'll do it this way. First, finding the bank discount first, right? Simple discount first, and then finding and subtracting, bank discount from the future value. And you might wonder, oh yeah, what about the future value? I mean, this promissory note, the formula says is bank discount is future value times D times T. Where's the future value? Well, this example doesn't have any future value. What does that mean? These are non-interest-bearing promissory notes. Non-interest-bearing promissory notes. What does that mean? This promissory note doesn't pay any interest. Oh, is that possible? How can they? I mean, you might. Didn't you say, Professor, that since sellers are reluctant to accept promissory note, or not very willing or happy to take the promissory note, to incentivize, they pay at least something equivalent to market interest rate. Yes, that's true. But sometimes, think about it. A very powerful industry giant, who is the buyer, and small supplier, small vendor, right? This is quite common. So, for example, because think about it, if you upset, you're a small supplier, you're a small vendor, and your client is a very big industry giant, and if you upset the client, there's going to be no repeat business, right? And the business with this industry giant could mean your total annual revenue, or like 80% of your total revenue. So you cannot upset, you cannot irk them, you cannot irritate, right? If you irritate them, it's going to be like a suicide, for your business. So sometimes, some big businesses are flexing their muscles this way. They don't pay any interest on the promissory note. They just, throw it in your, maybe not throw it in your face, but they just, they just hand out the promissory note, whether you like it or not, and it doesn't even pay interest, but you can't say no, right? You understand, right? The world is not a beautiful pie chart of rainbow. I mean, there's definitely power dynamics, right? So in that case, you can the promissory notes can be non-interest bearing. If the promissory notes are non-interest bearing, then that's what it is. The bank discount is then basically principal is the maturity value. It's principal as well as the maturity value, because there's no interest. Does that make sense, everyone?
Yes.
Yes, sir.
Thank you. Someone, okay, there was, who was this gentleman? He says, it wasn't just yes, but but it sounded like mumble. Who was this gentleman?
That was yes, sir.
Oh, he said yes, sir.
She said yes, sir. Yes, sir.
Oh, no. There was this gentleman who said, it was mumbled, it was.
It might have been
mumbled,
somebody walking past me.
Oh, okay. All right. Sorry about. All right, then.
No, my apologies. I'm at work right now.
Oh, okay. That's fine. So in this case, bank discount is all we need to do is principal times B times T. Oh, that's $20. Then your proceeds will be the difference between the two. That makes sense. Now, how about this one? $5,000 principal, The discount rate is 8%. They used 8% discount. And 90 days, oh, so I think everything is H. Okay. And these two, ordinary year. And also ordinary year, also ordinary year. And this is supposed to be exact year. This one is exact year and ordinary year again. Alrighty, so I'm gonna number 2 or row 13. Can anybody help me in this case? We find the proceeds directly. We find proceeds directly, and then subsequently find bank discount, and vice versa. So can anybody help me here? First, we'll have to. Would anybody?
I can try.
Okay, who is this?
Hannah.
Hannah. Okay, Hannah. All right. Yeah, go ahead. So starting with the time in here.
Equal.
Mm-hmm.
C13.
Yes. C13.
Divided by.
Divided by.
C12. No, sorry,
H12.
H12.
H12, yes. Okay, there you go. And then, so how do we get proceeds?
And then it's A13.
First, equal sign. Equal sign.
A13.
Yes. A13. Mm-hmm.
Times. Open parentheses.
Open parenthesis.
1 minus.
1 minus.
B13.
B13. Mm-hmm.
Times D13.
D13, yes, D13. All right. All right, so that's 4,000, proceeds is 4,900. Then what should be the bank discount? Hey, it's obvious, it's $100, but what's the math behind it? What's the logic behind it?
It's equal A13 minus E13.
Mm-hmm. E13, yes. There you go. All righty. So Hannah, you got 0.5.
Thank you.
You're welcome for helping me out here. Now let's do row 14. Would this time again is the same thing as row 12. Would someone help me here? Someone help me out. First thing is, of course, converting days into year, right? Would someone help me out here? Anyone? How about Hannah? Can you, you can, score?
Yeah, I can take if no one else want to do it.
Hannah?
Yeah.
Is that okay? Go ahead.
It's start with equal.
Hmm.
C14.
C14. Yeah, that's right. C14. Yes.
Divided by H12.
H12. Was it? Let me see.
The exact.
Oh, it's ordinary. It's still ordinary here.
Yeah.
Yeah. So here, yes, you got it right. But then, since we already had ordinary year in row 13, right? So we can just simply, we could have done it like this. We could have locked it and just, we could have dragged it down, right?
Yeah.
And here, we can also easily copy these two, but let's do this. So, we must, in this case, we must find, bank discount first. So, what do we do?
Equal A14
B14.
times B14 times D14.
B14. Yes, you're right. And once, yeah, that's the bank discount. And our proceeds are, how do we?
Equal
Mhm.
A14 minus F14.
There you go. Or you can also, alternatively, you can also just highlight these two cells, copy, and, because it's done in the same way, highlight these two. Or you can highlight only one cell, the left one, and then just paste, and we got that. Got pasted, right? But then also this borderline got pasted, so the borderline got pasted too, so I would leave it like this. Okay, that's good. That's good. Now, this is a problem. Remember, we had in simple interest, we had this exercise. I mean, where was it? This finding, yeah. When interest is given, right? When interest is given, how do we find time, rate, or principal? We can do the same, right? When interest is given, or when proceeds are given, when bank discount is given, or proceeds are given, how do we find the principal, right? We can do that too. We must think about, obviously, we need to tweak this formula. We need to tweak this formula, right? And think about it. So since B equals P times D times, and again, remember, although it is maturity value, but then here in this is non-interest bearing, meaning it's not paying any interest. So then future value is the same thing as the principal. Principal is basically the maturity value. You understand that, right? So we can write it like this. Also, D is basically P times 1 minus dt. Now then, let's think about it. How do we solve for, given B, how do we solve for principal, right? Given, it's easy. Now, tweaking this formula, right? Then P is what? B over dt, right? Also, given D, this one, given D, P is what? Can anyone help me here? Given D is known, then how do we solve for P? What's P then? How do we solve for P? Anyone? Anyway, Hannah, you got another 0.5 for,
You.
you're welcome, helping me out with the, so anyone? Look, from this, you can solve for P. To solve for P, then it is, B over dt. And then from this, solving for P, what do? To solve for P, what do? No one?
B divided by PT.
Yeah, speak up, please. And who is this?
Mohammed.
Mohammed, yes. Say that again.
I said
You
P.
divide.
Yeah.
You said what?
You divide the B by PT.
I'm sorry. It's just, please enunciate. P, so you divide what by what?
You divide the B over PT.
No. Where is B? There's no B. We are talking about this formula. We're talking about this formula, so there's no B.
I don't know then. I'm confused.
Look. There's no B here, right? With B, when B was, when the formula is about B, then you can tweak it. You can tweak it like this. You can solve for P by dividing B by dt. But here in this formula, there's no B, right? And then how many times did I tell you? Basically, all equations can be reduced to z equals x times y structure, right? And as long as you can identify that structure, solving for x is simple. If z equals x times y, what is x? Mohammed.
Z over Y.
Z over y, yes. Yes. And can you identify that z equals x times y structure here?
It could be P equals D over the 1 minus dt.
Yes, it is d over
1 minus dt.
1 minus dt. Yes, you're right. But then, why don't you answer the question I asked a while ago? I asked, do you identify z equals x times y structure here? And to that question, the answer is yes.
Yes.
It is this. In other words, you can say, yeah, d is z, p is x, right? 1 minus dt is y. In other words, step by step. Don't make a jump, because my immediate question was, can you identify this z equals x times y structure? And then the answer is Yes, d is z, p is y, and 1 minus dt is p is x, 1 minus dt is y. And then that would lead to this answer. Okay? Alrighty, Mohammed. Alrighty. That was, a bit, like, uh, winding road, but you got 0.25 point for answering that question. Now, um, so then let's think about it. So this one, so you know D, right? So how do you find the principal? Now, first thing you need to do is, of course, you will have to convert days into year. So anyone, this time it looks like exact year. We have to use exact year. So could anyone help me out here?
Is it going
Look,
to
it's
be equals C15?
okay. So is that Mohammed?
Yes.
Okay, C15.
Divided by H12.
Are you sure it's H12 because it's exact year?
Yeah.
But exact year is A12. A12. 360 is ordinary year, not exact year. Everyone knows
So is it
exact
gonna
number. Of
be H13?
course, it's going to be H13. And then principal should be, the principal must be, look, it's, come on, it's 440, you derived the formula for finding P, so what's it gonna be?
So is it gonna be DE15?
You must start with equal sign, start with
Oh
the
yeah,
equal sign.
equal
Mhm.
E15
E15, yes. E15, yes.
divided by
Divided by
parentheses 1
open parenthesis
minus,
and
yeah,
1.
open parentheses, 1
Mhm.
minus. So is it gonna be, DT is the D15?
D15?
Yeah.
D15, okay, but then look, 1 minus dt, what is d?
Oh, the 500.
500 is not d, it's a, look, lowercase d, lowercase 500 is uppercase d, which is dollar.
Okay, okay. So it's gonna be B15
D15,
times
mhm,
D15.
D15, yes.
I was just confused. My bad.
Yeah, but there's a, you
It's
see,
just like I know it's right, but I'm just like not just scared to say it because it's wrong. That's why. It's just like double-minded.
yeah, don't forget to close parenthesis.
Yeah.
And, yeah, but pay attention. There's a reason there's an uppercase d and lowercase d. Uppercase d is proceeds, lowercase d is the discount rate,
Yeah.
right? We have uppercase d here, lowercase d here. And hit enter, we got the principal, right? So if this is the principal and with 270 days left, if you're factoring or simple discounting or bank discounting, then using at 9% discount rate, uh, then your proceeds will be 500. And of course, we know what this should be. We know what this should be. So what is the then what is the bank discount? Hmm? What is the bank discount?
So equals
Mm-hmm.
A15
Mm-hmm.
times
Times. Well, you can do
B15.
it that way. You can do it that way, but we already
Solve
have
for
D. So what should be the bank discount?
the E15.
So what do I do about E15? I mean A15 just and then
You
E15 just
subtract it.
subtract. Yeah,
E15.
subtract E15. Yes, it's the difference between the two, of course, right? Now, all right, Mohammed. So for that effort, I'll give you zero point 0.5. Now, anybody for this problem? Anybody? We now know bank discount. So, and we must, 180 days is the discount period, right? Um,
You want me to do it again?
yeah, you can do it again.
Okay, so it's equal
Mm-hmm.
C16
C16.
divided by uh H13.
No, this time, look,
Oh, it's the or
can you
oh
see?
okay.
It's ordinary year this time.
Yeah, so it's gonna be H12.
Mm-hmm. And then, so
And then
what's it gonna be? Mhm,
equal
mhm.
500.
No,
Oh no.
don't give me the number. Where's the
E
data?
it's gonna be E15.
E15 is not, look, why E15? This problem is in row 16. We are here. E15 is there. It's a different problem. So this time, what do we need to do? Because in the previous example, it was the proceeds that was given, but this time it is the bank discount that's given. So if it is bank discount given, right? What do we need to do?
One. So it's gonna be C16
C16. Look,
times
C16 is days.
because it says that B equals P times D times T,
Yeah.
and we already have
Okay.
the B.
B equals P times D times T. So if you're solving it for P, you must solve it for P. Then what do you do?
So it's gonna be P equals B over D times C. So it's gonna be equals F16 over
16 over
uh B16
B16, B16
over
over
no I mean times
times
uh, D16.
D16. But then, is this okay? Is this good? Anybody? Can
The
anybody
the
tell me?
the open parentheses
Yeah,
and
yeah,
the in
right.
front of the and the closing parentheses.
You have to open parenthesis here
And here.
because look, what did I say? What did I say? Uh, our eyes can human eyes can tell d times t is one chunk, right? Even without the parentheses, we know we are doing this. We are dividing b by d times t. But in a computer language, I mean, in Excel coding, which is basically, a very basic form of computer language. Without the parenthesis, then what's going to happen without the parenthesis?
It's gonna
If you
input the
intend
wrong
to,
information.
yeah, it's going to do F16 divided by B16 first, and then multiplied by
Yeah.
D16. So it's going to end up in, you're going to end up in a very, you're going to end up in a wrong answer, right? So you got to make sure that to put the parentheses there. And hit enter. There you go. It looks more like it. First of all, use your common sense. If you use your common sense, right? Use your common sense. Think about it. It's $20,000 at 10% for if the discount rate is 10% a year, then for 1 year it's going to be $2,000. Isn't that right? Isn't that right? If the discount rate is 10%, and it's always annual. So for a year, it's going to be 2,000. But then how many days? What's our timeline? It's not 1 year, it's 180 days. 180 days is exactly half year, right? Half year, especially using, ordinary interest here. Then for half year, that should be half the 10% interest. And 10% interest, 2,000, half of that is 1,000. So even the common sense, you can check and confirm that you got the right answer, right? Makes sense? All righty. So that takes a lot of, I mean, by even today we should have already finished all this, but and then factoring, once again, simple discount is called factoring. Why? I'm going to get to that, but first we did interest-bearing, non-interest-bearing notes, and then we need to also look at interest-bearing promissory notes too. Why? First of all, non-interest-bearing note is a relatively special case. Generally, promissory notes carry interest. So think about it. This formula is the general case. This is the general case, right? In other words, okay, this formula and this formula are for general case because we will have a future value or maturity value of the promissory note that is different from the principal. So here, our example, So this formula is a special case. B equals P times dt, and D equals P times 1 minus dt. These formulas are a special case where principal is the same thing as maturity value. Because, why? Because it's non-interest-bearing promissory note, right? A special case where FV is the same thing as P, right? Because interest is 0. Okay. Now, do you all recognize this in 3 dots inverse in inverse triangular shape, right? 3 dots in inverse triangle. Do you all know what this is? Do you all know what this inverse triangle means? Anybody? What does that mean? Inverse triangle. What does that mean? That means, because or since. Okay? So that means these are special cases of the bank discount and proceeds formula where future value is the same thing as equal to principal because interest rate is 0. Make sense? Everyone? You got that?
Yes.
Yes.
Okay, good. So when we discount the interest-bearing notes, then we have to start with maturity value or future value. Okay. So this is the same thing as MV, right? Future value is the same thing as MV because we'll have to discount not the principal but future value because it's got interest, right? It's got interest. So this example, let's take a look at this example. Principal is $300,000 and interest rate is 10%. And this uppercase T means that's the maturity, terminal time. Uppercase T, why is it uppercase T? Because that's the terminal time, right? So 180 days, and 180 days is, you might think, oh, it must be exactly 0.5 year if it is ordinary year. But if it is, and here, the way I did it, I gotta, okay. So the way I did it, age 26. Oh, age 26 is there. 365. Oh, so this is exact interest year, right? This problem, right? So let me. This one was exact year. I'll copy that. I'll paste it here. Okay, so this one, exact interest here. I don't know, this is age 25, which will be, that is ordinary year. But you might wonder, how do you know whether it is ordinary year or exact year? Well, unless by default, the default is ordinary year. Default is ordinary year, right? So you assume ordinary year unless it is specified in the problem that you use exact interest year, right? So unless otherwise specified, default is ordinary year. Okay. So first, if the promissory note carries interest, we must find future value first, or the maturity value first. And it's easy. We already know. It's P times 1 plus R times T. P times 1 plus R times T. We got that. And then we need some narratives here, but the narrative is we are devoid of any narrative, but I'm gonna use the I'm gonna show you the practice problems from the book, Okay, so you can have some words there, but the scenario is like this. So you originally received a $300,000 promissory note with 180 days to maturity. So the maturity value will be this. But on day 120, not day 120, what's day 60. On day 60, you can't hold it anymore. On day 60, your company ran into some cash flow problem. So company has no, the company doesn't have money to make their payment, right? Short-term, obligations. So what do? They will have to take this. They don't have cash, but they have this promissory note, so they take it to the bank. So if bank buys this, they will have 120 days left until maturity. So they are taking over the risk. So they will discount it because they are bearing the risk for the remaining 120 days. So they discount it by 12%, and the 120 days is 0.33 year, right? By exact year, because we are using exact year assumption here, exact year. So then the proceeds will be D equals, right, F times 1 minus D times T. And then it's simple. Then bank discount is the difference between the two. So proceeds, that's what you get from the bank when you sell this promissory note. Okay, so then what is R star? I'm gonna get to that later, but before we, so as it's already 5 o'clock, so we're almost out of time. But let me do this. So let's just do one. Where is it? All right. Now, do you all see? Okay, and 11. 11.1. That's not interest bearing. Okay. Complete this practice quiz. So look, date of note, face value. Okay. This one. Remember, this is when the that's 12-1. The length from this, we can tell this is time 0, and if the length of the note is 160 days, then we can tell when is the maturity, because I'm gonna have to come back to this, but you remember how we did this problem when time is given not as length of days, but point in time, like a calendar date. Okay, so this is. We'll have to tweak this model a little because the time is given in calendar date. So it's obvious, you know, it's not a difficult thing. We just have to plug it into the right place. This is the principal. An interest rate is 11%. Length of the note is 160 days. Then we know what to do. We can find the future value, and the future value is this times 1 plus, right? This over 360, right? This times 1 plus R times this over 360, and we have the maturity value. When we have maturity value, then we can discount it for the discount period. And what's the discount period? Look, to find the discount period, right? Date of discount is June 8th. Then we can tell when is the maturity, because April 8th plus 160 days will give you the maturity date. Be it, you know, September something or October something, we will get the maturity date. And then since the discounting is happening, you took it. This means you took it to the bank on June 8th. So then September whatever minus June 8th will give you the discount period. Then you can find, you know, then you can find D, you can find B, right? We're out of time, so we cannot do that. But we're gonna continue this. This is really difficult. First, why? Because we are like 1 day behind all the time, right? Who was that? Was someone saying something? It's like someone was interjecting. Somehow this one. Okay, you don't see simple interest. So this is still visible, right? Simple discount is still visible, but actually today we are moving on to topic 2, right? The videos for today. And why is it like this? Oh. Actually, even from, this is crazy. Today is what, 26th, right? I think it was 20. It is 23rd, 5. Okay, it should have been. You see, if you go to the discussion board and if you go to today's forum, right? Where is today's forum? 20. Today's videos are actually Euler's number. Okay, so that's 26th. So actually, this was assigned. So we are already 2 days behind. We're already 2 days behind. So I want you to catch up with everything. Although I've been telling you in the Collaborate, we are reflecting. We are reflecting on the topics that were already previously assigned. But that's not where we are. You must keep up with all of this. So today's videos are basically Euler's number part 1, Euler's number part 2, and all of this. And on last Thursday was single cash flow model, future value, part 1 through part 4. So you must at least keep up with these videos, right? And you can't just rely on the Collaborate, because we are obviously like 2 days behind the schedule. You understand? Something about right. This should be visible. Why is it? Oh, okay. That's why. All righty. So the class dismissed. I'm gonna have to assume that you I see 7 people here. So I'm gonna have to assume that you are all Sarah, internet problem. Okay, and I will, let me check. So there are 12 people. 12 people on the 12 people on the forum sign-in sheet, but actually only like 7 people in the Collaborate. So I will